Hey guys, what's going on? Fannie Mae made some changes to their eligibility requirements that are right here. You can see that right there. Everyone's touting it as a good thing, but is it really? We're going to go into that right now. Check it out. Hey guys, how you doing? It's Will Caban, and as promised, I wanted to go through the Fannie Mae eligibility changes. Basically, in this video, I want to go through a few different things. First off, explain what the eligibility changes are, what they mean, what they were prior to the changes, and show you some numbers to show you if this is actually a good change or if it's not, and show you where it would actually benefit a borrower. So let's go into it. I'm going to share my screen with you guys so you can actually see what I'm looking at and get an idea firsthand of what these changes actually are, and then we'll talk about it in more detail. So basically, Fannie Mae sends out these announcements every so often. Anytime that they make a change, we as loan officers and mortgage professionals in the industry, we get updates on these. And some people look at them, some people don't. And I have a general idea that most people tend to just kind of skim over them and they don't look at the full details, or at least they don't discuss the full details. And this is the reason why I prompted this video, is because I kept seeing people say, this is, a really good thing, really good thing, really good thing. And mind you, this was announced today's the 13th, almost 2 weeks ago. And I purposely did not do a video for this because I was hoping that there would be some sort of direction on the issue that I'm going to present in a minute. But ultimately, let me tell you the hard line change that's going to happen with this credit score eligibility update. So in the past, 620 was the hard line rule for Fannie Mae to get a loan purchased and to close it and to price it out and to do all those things. So if you wanted to run it through Fannie Mae's automated system, which we call DU, you would need a minimum FICO score of a 620. And if you didn't have a minimum FICO score of 620, then by default, we would usually just look at an FHA loan because that would be the most favorable for you. And in this update with credit score eligibility, what's happening is they're changing the hard line mid FICO score rule from 620 to an average of both credit score on the loan application. Now, while that sounds great, I want to go into what that change looks like. And then I also want to go into where the pitfall lies. So this change, essentially, using this example over here, is taking into consideration a client with a mid FICO score of 619 and a second client with a mid FICO score of 693, using an average median credit score of roughly 656, right? So in the past, if you would have threw this through DU, it would have gotten it wouldn't have gotten approved. Now with the average, because the average credit score is a 656, there's a good likelihood, depending on certain parameters, that they're going to be able to get approved. Now, there's a lot of things that still DU would need to take into consideration, like the overall credit items, the late payment history, all those things, right? But let's just assume that everything is good with this 656 FICO score, and the down payment's not a problem, and it gets an approval. This is a good thing on the surface, right? Now we have a client who has lower than a 619 FICO score or lower than a 620 FICO score, and they can get approval. But here's where the one thing, and it's funny, it's surprising because it's right here on this, it's highlighted right in front of us. The one thing that I have an issue with is that no one is talking about the elephant in the room, which is the pricing on the loans. Okay. And why this is important is because when you look at the pricing on Fannie Mae loans versus, say, FHA loans, Fannie Mae loans use a pricing system called loan level price adjustments, or simply put, LLPAs. And if you want to Google this, you can go to Google and just Google Fannie Mae LLPAs, or you can just Google LLPAs. And what happens is when you go to the LLPA website, and I just happen to have it over here, when you have the LLPA website over here, basically what ends up happening is it's going to give you a breakdown of what the cost overlays are for this particular client situation. And what I wanted to do is I wanted to just give you an idea of what you're looking at when you're pricing out a loan, or when we on the loan side price out a loan, and how this has some detriments to it. So if we were to take an example of, say, 3%, right, 3.5% down, I want to keep apples to apples with FHA and Fannie Mae. If we were to look at a 620 or lower than 620 FICO score, we would have to look down on this pricing chart. Okay. Now, what happens is you see there's a 3.75 pricing overlay at a lower than 620 FICO score. But here's the problem. When you try to price out a 620 or a sub 620 FICO score, most lenders, us included, will not be in a position to actually price this out. We'll get an error message, such as this one over here, where it says disqualifiers, the FICO is below 620. Now, the reason why I wanted to wait so long to make this video is because I wanted to see if Fannie Mae was going to address this in some sort of way. So on the one hand, you have this good thing, and it's funny because they use the example of a 619 FICO score. You have this thing where it's going to allow you to get approved, but the problem is you can't get priced out for it. On a 619 FICO score, you're just not getting any pricing whatsoever. So when I tried to go into the system and I tried to price it out and I tried to manipulate it, try to change the down payment, try everything, I couldn't get priced out at 619. And the general consensus, because I'm, involved in the industry and I've talked to a lot of other loan officers, is you're not going to be able to get pricing at 619 with the lender. The reason for that is kind of plentiful, and I'm going to go into the reasons why. But ultimately, one of the main reasons why is because if you look on the pricing sheet right over here, and it has that little number 1 sign, look at what it says on number 1. A minimum required credit score of 620 generally applies to all mortgage loans delivered to Fannie Mae. And you got to refer to eligibility matrix for additional details. So nothing has been addressed as to how they're going to take into consideration loans that have a mid FICO score of, say, a 619, and the example that we saw above, on how or if we're even going to be able to sell them back to Fannie Mae. So this was the issue that I had with this, is because I kept seeing loan officers saying, hey, we're using the blended rate now, and Fannie Mae is changing the eligibility requirements for DU, which on the surface it sounds great, but when you start looking at it or peeling it back, is it really? I took the liberty of actually running the scenario in the system through my mortgage coach analysis on a 620 FICO score, because we can actually price out a 620 FICO score, and on a 620 for an FHA loan, and then a 640 for an FHA loan and for a conventional loan, just to give you guys an idea and some context. And I actually priced out a 619 so that you can see that for FHA as well, because you can actually price out a loan at 619 for FHA. And really what I was trying to see was if there was any difference in monthly payment, monthly rate, long-term savings, long-term payment versus each other, right? Versus FHA versus Fannie Mae. And what I found was actually quite surprising. And this is the reason why ultimately I don't necessarily think this is a great update. It might be a good update in relation to lower FICO scores in the 620 to 640 range, if there's certain property types that are being looked at, right? And I'll get into that. But when I go into the specifics of this program, and we're going to go into it right now, you're going to see the numbers really just don't make sense. Okay, so here you have the total cost analysis. And total cost analysis, for anyone that doesn't know, is a analysis tool that I use for my purchase clients, for refinances, for situations like this. And I like to see it visually because I like to see numbers. And the reason why I like to see the numbers is because the numbers are really what tell the story. And ultimately, when you look at these numbers and you compare them apples to apples, you're going to start seeing some interesting things. So remember, we cannot price a loan out at 619 on Fannie Mae as of today, September 13th. These changes are to be made with Fannie Mae next week on the 18th. So maybe there might be some changes, but as of today, September 13th, 2021, we cannot price a loan out below 620. So I'm using an example at 619 FHA loan, and across the board, we're using purchase price of $300,000. To keep everything even, I'm using a 3.5% purchase price. 3.5% down payment. And the reason for that is because 3.5 is the minimum for FHA, while you could do as low as 3% on conventional. But the truth is that I can't price out a 3% on an FHA. So to keep everything even, I'm pricing it out that way. And as you guys can see, going back to the loan level price adjustments, there's literally no difference in pricing because we have the loan to value between 97 to 95.01. So it's all the same at the 3.5% down level. So ultimately, that's something I just wanted to kind of throw out there so you guys had an understanding of why I chose 3.5%. So going to the numbers, we have the same loan amount, same purchase price, but the interest rates are going to be different, and in some cases significantly different. So looking at a 619 FICO score, no points, you're looking at a 3.375 interest rate on an FHA. The other thing that you need to take into consideration is that the FHA mortgage insurance monthly is less expensive. It's coming in at a factor of 0.85%. Okay. And that's a fixed standard mortgage insurance factor, 0.85%. Now, the one downfall with FHA is that it has something called an upfront mortgage insurance premium. That's 1.75% that gets rolled into the loan, which is why you see the loan amount slightly different than you see for the Fannie Mae scenarios in columns 3 and 4. And that's the only reason why that number is different. If you look at a FHA at 640 FICO score with no points, now the rate goes up, goes down a little bit because the credit score went up a little bit. So we have a 3.125 FICO interest rate based on a 640 FICO score. When we compare that to a Fannie Mae 640 at no points, we're coming in at 3.99. Now, why, you ask, right? Well, simply put, we have to go back to the loan level price adjustment factors. And this is where you see the pricing and the overlays generally being, substantial. So you have the pricing overlay at 2.75, and we have to factor that in some sort of way. So what that does is that drives the interest rate up on Fannie Mae, because that's how pricing works. Pricing works on whole numbers. And if you have loan level price adjustments or rate overlays for certain things, the rate's going to be higher or lower, right? Now, with that being said, what I wanted to do is I wanted to compare the last column at a 640 FICO score, what it would take to be equal to, say, a 720 FICO score. And here is the interesting thing. If you look at the 720 representative score and you just kind of take it across the board, right? So we're looking at 720 right here. If you take it down to the column right over here, the loan level price adjustment is 1% versus the 2.75 down here. So it's a 1.75% difference. So what that means net is that the rate would come down to 3.375 and it would cost you 1.75% in points, which points, if you don't know, points are basically a charge to the client to buy down the interest rate. And sometimes it makes sense and sometimes it doesn't make any sense. Now, here's where it gets really interesting, right? When we factor the monthly payment differences, we're always going to use the higher payment as kind of the placeholder, right? And everything else is going to be compared to it. So when you factor in your Fannie Mae at 3.99, your monthly payment is $1,641. When you compare that to the first scenario, even at 619 on an FHA loan, the monthly payment difference is $135.50 less, okay, than the Fannie Mae at no points. The second column is $176 less, which in this case, this is actually apples to apples, okay? And then when you start factoring in paying the 1.75%, it's only $100.58 less in that scenario. So when you factor in the second column versus the third column, right? The no point option on FHA versus the 1.75 option on Fannie Mae, you're actually paying $76 more a month, and you're paying more out of pocket by way of roughly, in this case, it's like almost it's a little bit over $5,000, like $5,200 in points. Okay. Now, when you look at the savings over a 50-month period, now this is where I'm looking in case you guys want to keep up with me. Okay. If you look at the savings over a 60-month period, which is a 5-year period, again, comparing the second column to the last column, you're going to save $10,400 over that 5-year period versus $3,400. So you're going to save a total of over $7,000 in that 5-year period. And when we go down and look at the interest and mortgage insurance paid over a 15-year period. Now, 15-year period is a pretty aggressive period, but I highlight this because there might be an opportunity where people keep the home for that long. But let's just say that you keep it, you're going to be paying only $1,000, right? Not even $900 more in interest and mortgage insurance paid. The reason why that's slightly higher in this scenario is because mortgage insurance for conventional loans will drop off. Okay. Now, a very important fact that I need to explain to you guys is the mortgage insurance for FHA is set at 0.85%. The downside to that is that it's there for life, right? You have that 0.85 that you're paying for the life of the loan. Whereas the interest and mortgage insurance paid on the conventional loan is actually higher at 1.08%. Okay. But it drops off after you hit 20% loan to value or 80% loan to value and 20% with equity. So you don't have it after a period of time. And after 15 years, it's going to drop off at some point. But what we're not talking about here, which is something that would be highly encouraged, would be the benefit of refinancing at some point to remove the mortgage insurance from the FHA loan and go into a conventional loan. But not talking about those points, just keeping apples to apples. If you were to keep this property at least 15 years, you're only going to pay about $900 more over that long term. Most people statistically right now are staying in their homes anywhere from 7 to 12 years. So there's a good likelihood, even if you kept this loan, that you still would make out in the long term. So the point that I'm trying to make is, while Fannie Mae is making these adjustments and they're making these changes, the question I have is why? Why? Where's the net benefit to doing this? If we can't price the loan out, if the rate's going to be higher, the mortgage insurance is going to be higher, if we're going to have to pay more to buy down the interest rate where you would need it to be for FHA, where's the benefit? Now, I'm not an advocate for FHA or Fannie Mae. I'm an advocate for what's best for the client. And in this scenario, if I was presented with this scenario and I can't price it out, or I'm pricing out a significantly higher interest rate, I'm most likely going to ebb towards the FHA product. The only scenario where I can see this being beneficial is if you were to buy a condo. And the reason for that is because a condo is very difficult to get qualified through FHA. And at least in South Florida, it's very difficult because of the insurance requirements, because of the underwriting process, because of the approval process. It's very difficult. So the point that I'm trying to make with this is that when you're in a position to look at this as a benefit, I can only look at it as in a condo situation. Now, even in that situation, I do want to make an important note, something that I did not highlight in these notes because I didn't want to get it too convoluted. But when you look at the loan level price adjustments, okay, let me just take these annotations off. When you look at the loan level price adjustments, going back to Fannie Mae, what you're going to see, and something I did not bring up, is that there's an additional loan level price adjustment for a condo. And that's 75 basis points when you're putting down less than 25%. Okay. And that's actually right here highlighted. So the rate would be higher, even higher, okay, in a situation like that than what I had mentioned on the total cost analysis. So the point that I'm saying is that in theory, it would be a better product, but it may not be, because the interest rate might be so high that it might push you into a different direction of looking, say, for a townhome that's fee simple or lot block, or a situation where you might look at possibly just buying a single family home. So the point that I'm trying to make is that before you make a decision, and as loan officers, I mean, we have to do a better job at educating and going over the full facts and going over everything, because some things may be good, right, in the surface. They may potentially have some sort of added benefit. But in this situation, I really don't see where the added benefit is unless Fannie makes some directive to change the pricing, or at least change the loan level price adjustments for the pricing modules, because all lenders right now are all in the same situation. We all use the same loan level price adjustments. Some might have smaller margins than others, but you're not going to see a significant difference in the way that certain things are priced out. So in short, that is my rebuttal to this, madness that I see with people going in and saying that this is a great thing. I don't think it is, at least until this loan level price adjustment and pricing and rate issue gets addressed. I really don't think it's a great thing. If you guys think different, or you have any thoughts to share, if you have any ideas about, what's going to go on or what's going to happen, I'm always open to it. I really, value anyone's opinion, and I'm open for discussion on it. So thank you guys. Take care.